Right, so welcome to this meeting of the Economic Society of Australia, Queensland on this Remembrance Day. My name is Timothy Wanhoff, and I'm the president of the Society. I'd like to thank our hosts, Morgan's Financial Limited, for allowing us to use this space. I'd like to thank Jeremy White of HSBC for suggesting this event and helping to make it happen. And I'd equally like to thank our secretary, Jean Tunney, as well as Harriet Smith for their work in putting this together. If you need to use the restrooms, they're located at the end of the hall. If there's an emergency, listen for instructions or follow Michael Knox out of the building. Look, in the wake of the mining boom, there are just many questions about Australia's next source of growth. Now, Australians have grown accustomed to high standards of living, extensive social safety networks. However, these luxuries come at a cost. Now, Malcolm Turnbull has suggested that Australia should embrace innovation because it plays to our national strengths, things like education, research, biotech, and other such areas. With a falling Australian dollar, some have suggested manufacturing, but history, productivity, and wages relative to global competitors make this perhaps maybe less than likely. Services, however, has potential, and here to talk to us about that potential is Paul Bloxham. Paul Bloxham is the chief economist of HSBC, Australia and New Zealand. Prior to joining HSBC in 2010, Paul spent 12 years at the RBA in a range of roles with their economic department, including heading up the overseas economics and financial conditions area. Paul received a master's degree in public financial policy from the London School of Economics. He's a member of the ANU's Shadow Reserve Bank Board, and he's a professor of economics at Curtin University. Now, in a moment, I'll invite Paul to the podium. He'll speak for approximately 40 minutes. This will be followed by a Q&A session for 15 to 20 minutes, and after that, Michael Knox, the chief economist and head of strategy for Morgan's Financial Limited, will come and deliver a vote of thanks, and we will have you out of here by 1:30. With no further ado, I give you Paul Bloxham.
Thanks, Timothy. It's a great pleasure to be up here in Queensland, and a real pleasure to speak to the Economic Society. I am a member of the New South Wales branch of the Economic Society, and in my time at the RBA for a couple of years, I was the secretary of the New South Wales Economic Society, so it's not as though I don't have some attachment also to the Economic Society through time. I want to talk about what's going on in the Australian economy, but before we do that, I want to talk about the global story as well. It is fair to say that I'm probably one of the more optimistic economists when describing the outlook for the Australian economy. I have been for a little while, and I often think to myself, why is that? Why am I a bit more optimistic than some? And I think a big part of that story comes down to the fact that Australia has strong ties to the Asian economies. We are still quite positive about the outlook for Asian growth. We think that even though growth is slowing down in China, which indeed it is, it's slowing down from 10% to now running at closer to 7%, we're still talking about very rapid growth rates. Australia is still tied to the fastest growing region in the world, the Asian economies. And so I think that underpins and informs my relative optimism about Australia's economic prospects. Obviously, a big part of that story has so far been our mining boom and the ramp up in the resources story. That's now going in reverse. And so the question is, as that mining story comes to its end, the mining boom is over, what's the next driver of our growth? And that's a big part of the theme that I want to talk about. If you look just at the last 7 years, of course, it's been a tough time in the global economy. Conditions have been very weak. The global financial crisis, you're all aware of what's been going on, and it's been a really tough time for economies across the world. One way to think about how Australia's performed so far is to look at GDP and say, well, where are we relative to others? Over the past 7 years, since the early part of 2008, just prior to Lehman's failing, the Australian economy has grown by 20%. We are 20% larger than we were. Our GDP is 20% bigger than it was. That's actually quite impressive when you compare it to the range of economies across the world. If you compare it to the US economy over that period is 9% larger. And we all know that in order to get that 9% growth, policymakers have had to literally throw this kitchen sink at the economy. They've cut interest rates to zero. The Federal Reserve had 3 batches of quantitative easing, printing money in effect to try and support growth. The government went from a fairly low government debt country to a higher government debt country as a consequence, given the fiscal stimulus that was delivered to try and support growth. And with all of that policy stimulus, they have only managed to grow by 9% over that period. That is actually quite impressive, though, when you compare it to the Europeans. You look across the Atlantic, the European economy is now exactly the same size that it was in early 2008. It had the global financial crisis, which saw a contraction, and then it had the European financial crisis, which came along in 2011 and 2012 and saw more of a contraction. And the European economy is improving now. Growth is running at about 1.5% at the moment, but its economy is still the same size that it was in early 2008. It's no larger than it was. And so against that backdrop, it really does make Australia's performance look quite impressive, and it does beg the question as to why we've performed as well as we have. Well, a big part of that is our strong ties to China. The Chinese economy is 80% larger than it was in early 2008. And of course, a big part of that story has so far been about resources, but we think increasingly it will be about other stories as well in terms of Australia's own growth prospects. So I want to talk a little bit about the global economy and set the broad global scene, some of the things we're seeing, and then I want to tell you more about our outlook for Australia. We do think that Australia is going to manage to pull off this great rebalancing act that we've been describing for a number of years now. Jeremy in the front row from HSBC will be very familiar with me using that term because I've been talking about and writing about Australia's Great Rebalancing Act since about mid-2012 when the mining boom peaked and we started saying, well, what's going to happen next and can we pull this off? And so we've been talking about this rebalancing of growth. I think there are clear signs that it's now underway. You're seeing it most vividly in the housing market, in the housing construction story, but you're also starting to now see it in other areas. So business conditions more broadly have been improving in over the past few months, certainly since the beginning of this year. And we're seeing the services sectors are leading the way in terms of driving Australia's growth at the moment. But of course, we're not separated from the world. The rest of the world drives a lot of the forces that are going on in Australia, so it's worth taking a look at what's been going on. I must say that for this year, the major obsession from most of my client base across the world, visiting people, has been with the Federal Reserve. It's all been about watching the Fed and when the Fed might start to lift interest rates. That's been almost the sole focus for many analysts, particularly traders, looking at what's going on. So all eyes are on the Fed and what its next move might be. The US economy is gradually recovering, but as I said, it's been a long, drawn-out process. This is a chart of US GDP growth, uncharacteristically or very different to a very different performance to the recoveries we've seen from previous recessions. A much milder recovery we've seen out of this very deep downturn that we saw after the global financial crisis. And one of the lessons we've learnt along the way, something that Rogoff and Reinhardt pointed out to us in the early part, in fact ahead of this story, was that this time would be different. It would be different because, or in fact the irony of their comment was that it's the same as previous financial crises, but it's different to previous recessions. And really what we've learnt is that when countries go through balance sheet recessions, when it's about debt levels being excessive and asset prices collapsing, it takes longer, much longer, for a recovery to take hold. And indeed, it's required a lot more policy stimulus to get there, as I've already mentioned. So the recovery in the US is underway, but it's been a fairly tepid affair. We've still got the Fed funds rate at zero. The fact that the Fed funds rate got down to zero just after Lehman's failed in 2009, or it failed in 2008 and the Fed funds rate got down to zero at that point in time, the fact that we're still at zero and we're debating as to when it's going to be lifted now in 2015 is it's been quite an extraordinary period for the US. The US growth rate is running at about 2% at the moment, though. We are back to an approximate trend growth rate for the US. As a consequence of that pickup in GDP, the modest improvement we're seeing, the being on the path to recovery, we've seen the labour market has also been improving. The unemployment rate has fallen to 5% on the latest print, which is approximately full employment for the US. And so getting back to full employment, the Federal Reserve has started to give the right hints that they say, well, we're now back at full employment. We should expect this to start to put some upward pressure on inflation, some upward pressure on wages, and we don't want to be getting all the way back to our inflation target before we start lifting the Fed funds rate off zero. We want to be headed back towards some sort of neutral rate, whatever that happens to be, well ahead of inflation getting back to its target. What does inflation look like? Well, still quite benign in the scheme of things. So this is a chart of the US core measures of inflation. You can see the core PCE, which is the major one that the Federal Reserve focuses on, is still sitting quite low at about 1.3%. Their target is 2%. It's not even really showing that clearer signs that it's moving in the right direction. And so it's a hard task for the Fed to make this decision to say, what we need to do is we need to start lifting interest rates ahead of the fact that inflation will get back to its target. But of course, we don't want to start lifting them too early in case that dampens growth and then we are forced to reverse course. That would be something they really want to try to avoid. We do seem to be getting enough evidence, though, building up, particularly in the last couple of months. In fact, last Friday we got the payrolls numbers. They were on the strong side, 271,000 jobs created in October in the US, and that's quite a strong number. And it does look as though the Federal Reserve may have enough evidence to start to lift interest rates very soon. Our own expectation is that is likely to arrive at the 15-16 December meeting, the next Federal Reserve meeting, that they're likely to start lifting the cash rate, or the Fed funds rate. We do think that's going to be a really slow path, though. We think the US recovery has still got a fair way to run. It's still the case that inflation is well below target, although the labour market's back to its full employment level. There is pretty mixed signals that wages pressure is picking up. So we think it's going to be a really low, slow, drawn-out process of the Fed lifting interest rates through next year and through the following year as well. For what it's worth, we've got in mind they lift to 25 basis points in December and then they get to 75 basis points by the end of next year. So that's 3 hikes by the end of next year. That's a very slow hiking cycle in the scheme of things. But it is a broadly positive story in the sense that the US is finally starting to get back to some sense of headed towards normality. There is a recovery that does appear to be underway, and you can see it most vividly in terms of what's going on in the labour market. This is a good story for the rest of the world for 2 key reasons, for a number I'm sure, a number more than that, but for 2 key reasons in particular. And the first is the US is still the largest economy in the world, and so if its economy is recovering, it will be somewhat of a source of demand for goods and services produced by the rest of the world and should help to support global trade, although global trade has been very weak recently, so there are big questions around that. But nonetheless, an improving US economy is better than one that's deteriorating. And then the second factor, I think, which is really quite fundamental and important at the moment, is if the US economy is recovering and it's genuinely showing some strength, such that the Federal Reserve thinks they can start to lift interest rates, then it is justifying the fact that the US dollar has strengthened in recent times, and it may very well see the US dollar strengthen further as we look further forward. This is a good story for the rest of the world, because what the rest of the world has wanted, and most countries across the rest of the world have wanted, weaker currencies. They want support, and they want their competitiveness to be improved by having a weaker currency, but you can't have a weaker currency unless someone else has a stronger one. And of course, picking the candidate for having the stronger currency has been quite tough. No one has had a particularly strong economy. If the US economy is recovering, then the US dollar can afford to be stronger. The other currencies can afford to go down some more. That would be helpful for Europe. It would be helpful for the Japanese. They've already seen quite a large fall in the yen. It would be helpful for Australia. A lower currency would be quite helpful in terms of supporting the rebalancing of Australia's growth from mining to the non-mining sectors. So, on to Europe. Well, Europe, as I said, had the global financial crisis and then the European financial crisis, and the combination of those 2 contractions in their GDP have meant that even though things are improving now and they are actually growing, albeit at a pretty slow pace, their economy is no larger than it was back in the early part of 2008. However, they are on a more stable path. The indicators have picked up over most of this year. They do face some enormous structural challenges, and we're not talking about European growth racing away. Growth is running at about 1.5%, and we think it'll track between 1 and 1.5% into next year as well. So these are not particularly rapid growth rates, but it is good that the European economy is somewhat stabilising. So this is a chart of an indicator that I keep track of for Europe. It's a collection, a coincident indicator that averages a whole range of other measures, including the PMIs and the labour market numbers. So it's a very useful summary statistic if you want to have a quick snapshot of what's going on in terms of European conditions. You can see that when it falls below 0, it means the economy is generally contracting. When it rises above 0, it's telling you that things are expanding. You see the impact of the global financial crisis and then the European financial crisis, and now you can see that it's been in expansionary territory for a couple of years, and in fact through this year it's been gradually improving. Why has European growth been lifting this year? Well, there have been at least 3 key factors at work in our view. The first has been The ECB finally embarked upon a quantitative easing program, which it started in January. So much like the Fed had been doing for a number of years, the Fed had gotten ahead and done quantitative easing to support growth. The Japanese have been doing for many, many years now. The ECB has also embarked upon quantitative easing to support growth. Another factor has been that the euro came down a fair way last year. So the lower euro has been somewhat supportive of competitiveness in Europe and supporting the traded side of those economies, particularly the German economy. And then I think the third factor, which is probably the most fundamental one, and that is the halving of oil prices we saw last year. If you remember, back in July of last year, the oil price was $110 a barrel. By the early part of this year, by January, it was sitting at about $40 a barrel. It's now sitting around $50 a barrel. So the halving of oil prices has been a positive influence on the European economy. Europe is just a net oil importer. They do not produce any oil, unlike, of course, the US. The US has gone down the path of a lot of the investment we've seen in recent years has been in the shale sector, and of course when oil prices fell, that hit that sector quite hard. So it's not been, although it's probably still been a net positive for the US that oil prices came down because it boosts their disposable incomes, it's not been not as clearly a positive as it has been in previous cycles because they've had this big shale sector that's been expanding. For Europe, it's just a net positive. A fall in oil prices is positive for the households and they've had more disposable income to spend. So that's been lifting European conditions. But neither of these economies are racing away, and that's the important point to keep in mind. We're talking about US growth of about 2%. We're talking about European growth of about 1 to 1.5. These economies are in a much slower grind than they have been in the pre-global financial crisis period. And it's rather fortunate for Australia that we're not highly tied to the US or the European story. We're much more tied to the Asian economies. China's growth is slowing. This is obviously something that captures a lot of headlines. China is not growing at double-digit rates anymore. We're not talking about 10% growth. We're talking about, at the moment, running at about 7% on the GDP numbers. And in fact, the fifth plenum, which has just been completed, which sets out a lot of the details for the 13th five-year plan that the Chinese are putting forth, suggests that they are planning to try, which is a goal they've mentioned before, to try and make Chinese GDP double between 2010 and 2020. And because we're at 2015, we know roughly how much GDP growth that implies by 2020. They need to grow at a minimum of about 6.5% per annum over the next 5 years to achieve that goal. That's their objective, right? So growth has slowed. We're not talking about GDP running at 10% anymore. We're talking about it running at 7%. And actually, the bottom line from the policymakers' perspective in China is they need to grow at about 6.5%. There's a lot of sensational rhetoric that gets thrown around, particularly in the media, about the idea that you should be really worried that China's slowing down. Every year goes by and it's a slower rate that we're talking about. Oh, it used to grow at 10, now it's growing at 9. What happens if it slows to 8? Oh, what happens if it slows to 7? What happens if it slows to 6? And I think a lot of that gets, it's a somewhat unhelpful way to think about what's going on in China, in my view at least. So one way to try to think about this in a slightly different way is to look at a chart like this. This is Chinese GDP growth in the black line. This is the way we would normally think about it, percentage change, GDP growth. But it is worth keeping in mind that China is a whole lot bigger than it used to be, right? Back when it was running at double-digit rates, when it was running at 10% per annum, which it averaged over the past 30 years, of course, China was a much smaller economy. We know this. The rule of sevens tells us this, right? You know, if you grow at 10% per annum, then you're doubling in size every 7 years. 70 divided by 10, that's the rule of sevens. If you're growing at 5% per annum, the same rule, you'd be doubling in size every 14 years. Well, if you double in size every 7 years, as the Chinese economy had been doing, eventually you become a big thing. And indeed, that's what happened in China in the mid-2000s. So back in the 90s, you can see. So what I've shown here, the red line, is the same growth rate, but instead of showing it as a percentage change, I'm showing you the amount of extra economy you get from Chinese growth, the amount of extra US dollar value of the economy you're getting each year as their economy's been growing. I'm multiplying the size of the economy by the percentage point, and I'm therefore taking account of the base, if you like. So the bottom line here is back in the 90s and the early 2000s, China was growing at 10%. But it was a small economy growing very quickly, and so it wasn't really contributing that much to overall global GDP growth. Well, if you grow at 10% for long enough, eventually you become something quite large, and that's what happened in the mid-2000s. China's growth slowed down, in fact, but because it was so much bigger, the base effect worked very hard, and China was contributing the most to overall global GDP growth when the global financial crisis struck. If you look further forward, you can see although China's growth has been slowing, and the black line I'm using here is IMF forecasts, and in fact they've got a more downbeat view than we do, which is they've got growth slowing to 6%. Even as it's slowing to 6%, the contribution you're going to get to overall global GDP growth is still about the same that you were getting when it was running at 10% in 2010. So the point being, China's growth slowing down, it makes sense that it's going to, for a start. China is now the second largest economy in the world and the largest player in many markets. There are 50 countries in the world where China is the number 1 or number 2 trading partner. So it's a little hard to believe that they can expand their way at as rapid a rates as they used to and be able to do that by expanding into new markets. They're already the biggest player in many, many markets. So it's hard to think that that's going to be the driver of growth. And then their own domestic demand has been a driver of growth recently. But of course, it can't continue to grow at those rapid rates either. But if you put that red line in context relative to the rest of the world, what you're left with is China's GDP growth may be slowing down, but its actual contribution to global growth is fairly stable in the outlook. And of course, it is still the single largest contributor to overall global GDP growth, even though the US is improving. Growth is lifting over the horizon in the US. Well, the Chinese economy is slowing down, but it's still contributing more to overall global GDP growth. While we're here, it's worth pointing out that although we've got a fairly positive story about India, and indeed we can come back to India in just a moment, the Indian economy is still pretty small. So even though India is expected to grow faster this year than China, we expect growth of 7.8%. In China, we expect growth of about 7%. Even though India is expected to grow faster, of course, it's a whole lot smaller. So its contribution to overall global GDP growth is a whole lot lower than the Chinese contribution. The bottom line is, it's a little hard to get overly worried about the China story when the Chinese growth forecasts, even if you pick the lower end ones, are still telling you that you're going to be that's going to be the single largest contributor to overall global GDP growth. Now, that's not to say that there aren't challenges. China faces enormous challenges. Prior to the global financial crisis, the Chinese growth model could be very briefly and quickly summarized as this. What you do is you export manufactured goods to the Western economies. To do that, you build up a manufacturing industry and you keep it competitive by keeping your currency quite low. Okay? So you sell those goods to the West. When those profits come back, you stop them at the door, you push them back into US government securities, build up your reserves. Right? That keeps your currency low, keeps your manufacturing industry competitive, and of course pushes that capital back to the US and to the Western countries, where they can use that cheap capital to borrow more, right, in order to buy more of your manufactured goods. And that's exactly what happened. And that model worked fabulously until it stopped working. And it stopped working when, of course, that capital that was flowing towards the US ended up in the wrong spots. It ended up in the US housing market and ended up pushing up house prices, causing a house price bubble, the subprime crisis, and so on, and then the bubble burst. House prices fall 35%. That model doesn't work anymore. You can't sell those manufactured goods because everyone's got too much debt in the US and they need to work it off, and that demand has dried up. So what do you need to do? You need to shift your growth model quite quickly, in fact. And indeed, we're all very fortunate, Australia in particular, but the world as a whole, that the Chinese did shift their growth model. They pulled the lever on a whole lot of infrastructure and housing investment, which was a good story because they hadn't built much housing, they hadn't built much infrastructure, they'd been very focused on manufacturing, and they needed to do that. So they did. They pulled the lever on a lot of infrastructure and housing investment. Of course, that led to a sharp pickup in commodity prices. That led to our mining boom, and we'll come back to that in a moment. And of course, that growth model worked quite well to support global demand for commodities, and it drove growth in China as well. But that model could only last so long as well. Eventually, they've started to build too much housing in the wrong places as well. To some degree, they've collected debt levels that they need to work through as well, and there's been some misallocation of capital. So the Chinese growth model now needs to shift again. It needs to shift from being a story that's all about manufacturing and exports and a story that's been about investment to one that's led by the consumer. There needs to be more of a focus on the consumer driving more of their growth. Their growth needs to rebalance from an investment-led story to a consumer-led story. And so the question is, how do they do that? And how quickly can they do that? And are they doing it? Well, how do they do that? Well, one of the things you've got to do in order to get people to consume more is you've got to deregulate your financial system. Because if people are going to save less and spend more, they've got to be able to be secure in being able to reduce their saving rates and do a bit more spending. That's actually quite hard to do. Building a financial system that works takes many, many years. A lot of institutional arrangements need to be set up. And so that's one of the things they're trying to deal with over time in order to achieve that objective. Is it happening? Well, the answer is yes, in the numbers. This is GDP. broken up into primary, secondary, and tertiary. Secondary is manufacturing and construction. Tertiary is the services sectors. You're already seeing the services sector is a larger share of overall GDP in China. In fact, it's also a larger contributor to GDP growth in China. The Chinese middle classes are rising. Their incomes are picking up, and they're spending more of that on services. That makes sense. That's exactly what happens in the developed world. As countries develop, they spend more on services. Health services, travel services, entertainment services, the range of services become a larger share of what China is demanding. And of course that leads me to the next conclusion for Australia, which is we've been very much focused on providing the resources side to the Chinese investment boom that's been going on. The next opportunities for Australia in terms of exporting to China are likely to come in terms of exporting services. And we'll come back to this theme in a moment. I just want to touch on a couple of other countries so that when we get to the end and you ask me questions, because often this happens and someone says, but you didn't talk about, I can at least say that I've talked about a few more countries, not just the China, the US and the European story. So very briefly on India. India's growth is picking up, okay? India is improving. A watershed moment was the election of Narendra Modi, the big shift in politics that happened in May of last year. The biggest shift we'd seen in Indian politics in about 30 years. A reformist agenda was put in place, and Narendra Modi was, of course, quite a successful chief minister in Gujarat, so he brought that reformist agenda with him. And that's been quite helpful in terms of supporting a more positive outlook for the Indian economy. But he's also had some great fortune, some great tailwinds, and the most clear tailwind has been the sharp fall in oil prices. India is a very large importer of energy, and the 50% fall in oil prices narrowed their current account deficit substantially. They got a current account surplus for a short period of time, but it's a much narrower deficit than it was, allowed the central bank to cut interest rates, which were quite high, and inflation came down. So there are a collection of things that have been working in the favour of India. The reformist agenda is rolling out slowly, as you might expect, but India has got lots of good prospects in the scheme of things. We're talking about a country that's got very low GDP per capita, has an enormous scope for convergence, and in a way, it's not so much what they do. It's that if the policymakers were to step out of the way and remove some of the constraints, one would imagine the Indian economy would grow in and of itself. It also needs infrastructure, which is what the government's very focused on. So we are quite positive on the Indian outlook. We do think India's growth is lifting. Asia is not doing so well, the rest of Asia. I won't focus on Japan too much. If you want to talk about that, we can ask about it in questions. But a lot of the Asian economies are very much tied to the global trade cycle. And of course, manufactured goods trade has been quite weak in recent times. A very big explanation for that story is the general reluctance in the Western countries in particular to ramp up their investment. The one thing we've seen an improvement in consumption in the Europe and the US, but the investment numbers are still very weak. Corporates seem very unwilling to take risk and be prepared to make investment plans. And when the investment cycle is weak, the trade cycle is weak, and those two things are quite well related. So a lot of the reason why the Asian economies have been on the weaker side has been a weak trade cycle. It's also been, of course, that they've got a strong attachment to China, and China's growth is slowing down. In fact, China's investment is slowing down as well. So this has been a tougher time for Asia. The Latin American economies and the African economies are also doing poorly. In fact, they're doing very poorly. The commodity crunch has gotten very painful for them. And that will lead me nicely. I'm going to tell a little story about Brazil before we talk about Australia, because it's a nice way of contrasting what happened to what happened in Australia. Because both countries had some similar forces from the rest of the world on them, right? China's boom in its investment led to a very strong ramp up in commodity prices. Iron ore prices got to record highs, and a whole range of commodities went to record highs. Now that is a big deal for Brazil, much like it is for Australia. They're a big commodity producer. How did they respond? Well, what they did was it put a lot of upward pressure on the currency, on the real. And so the Brazilian authorities didn't like that very much. So they started dabbling with putting taxes in place to try and keep the real down. Remember, they put a Tobin tax in place for a while, tried to constrain capital flows, tried to keep the real low because, of course, they wanted to protect their manufacturing industry, about 25% of the Brazilian economy. And they did that. They did all of that. The mining boom was going, and they protected their manufacturing industry to some degree. So actually everything was going all at once. That's what happened in Brazil. Growth was picking up everywhere when the mining boom was strong. The trouble with that strategy, of course, is if everything picks up all at once and the economy is booming, then it tends to lead to inflation. And that's exactly what happened. So inflation picked up. And then what happened? Well, commodity prices peaked in late 2011, and their mining boom peaked and it started to come down. And of course, everything had been growing very strongly, so inflation was quite high. So rather than the central bank being able to cut interest rates to stimulate growth in all the other sectors of the economy, they had to lift interest rates in the face of this negative commodity price shock. And of course, that squashed domestic demand, forced them into recession. They've still got inflation that's still persistently high, a problem for them. They're still trying to fight that inflation at the same time that growth, the economy's shrinking. They're in quite a deep recession. And then you've got all of the other political issues that have been going on as well that have been constraining Brazil's growth. Now, Brazil's a great contrast to Australia because we had the same forces, right? Commodity prices ramped up substantially, got to record highs in 2011. But what did we do? Well, we did something quite different. The central bank decided what they needed to do, having learnt from looking at every other mining boom in Australia's history, where we had a very similar, or a somewhat similar experience to Brazil, where mining would pick up, wages would pick up in the mining sector, inflation would pick up across the economy, the whole economy would boom all at once, people would spend lots, the manufacturing industry would take off, the whole thing would lift, and then when you get to the end of the mining boom, well, there's nothing left to grow, and inflation's high. So nothing left to do but have a recession, you have a downturn. And that's the experience we've had in every other mining boom in our history. We've had the mining booms flowed through to the rest of the economy, the whole economy's boomed, and then the whole economy's gone into recession. Mining boom followed by mining bust. Well, this time around it was very different. The central bank lifted interest rates in 2010 and 2011. Remember, we had a cash rate of 4.75% in 2011 when the Federal Reserve was at zero. Most of the world was cutting interest rates and getting them down to extraordinary lows and starting quantitative easing programs, at least the Federal Reserve was. So as a consequence of lifting interest rates to quite high levels, we also had a very high Aussie dollar. At one point in time, in May of 2011, we had an Aussie dollar at 110 against the US dollar. Through 2011 and 2012, we averaged 105 against the US dollar. So high interest rates and a high Aussie dollar slowed down everything outside of the mining industry to make way for that mining expansion to happen without excessive inflation. It was the biggest mining investment boom we've seen in the history of our country, and probably the biggest one we'll ever see in the scheme of things. Mining investment went from 1.5% of GDP on average over the past century to 8% of GDP in 2012. 4 percentage points of that came along in just 2 years, in 2011 and 2012. In 2012, mining investment was contributing over half of all GDP growth in our economy, even though the mining sector is only 10% of the economy. 10% of the economy was growing that fast that it was contributing over half of all GDP growth. So it was an exceptionally large mining investment boom in order to absorb. And my job at that time was to travel around the world and travel around the country and talk about the multi-speed economy, or the two-speed economy, if you like. Mining was going gangbusters and everything else was sluggish. Housing construction was falling, house prices were declining, the manufacturing industry was in a downturn because of the strong currency. Everything was weak. Excuse me. Too much exuberance. Get ahead of myself. I gave a presentation. I gave 3 presentations, big room presentations yesterday. So I've been on the road. I've been quite busy, speaking, doing lots of talking. So where was I? So this mining investment boom was enormous, and in order to constrain the rest of the economy, to keep it contained, so that at the end of the mining boom there was something that could pick up, and so that we could keep inflation under control, so that the RBA had room to be able to cut interest rates afterwards, well, they had to keep very tight financial conditions. And that's exactly what they did. They kept tight financial conditions, held back everything outside of the mining sector to make way for the mining expansion without excessive inflation, so that they could cut interest rates at the end, hope that the Aussie dollar would come down, and that would provide support for all those other sectors of the economy. And that's the rebalancing act that the RBA has been trying to pull off. And indeed, so far, it's been actually reasonably smooth. Not perfectly smooth. GDP growth has been below trend for the last 3 years, but we're talking about GDP growth of about 2.4% per annum. We're talking about an unemployment rate that's gone from 5% to 6.25% and is now stabilising at about 6.25%. So it's not been a perfectly smooth transition where one goes to the other, but that transition is clearly underway, and it's a whole lot better, of course, than the historical experiences we've seen in Australia, but it's also a whole lot better than other countries which have had similar sorts of forces working on them. And in fact, don't let me get started about Africa, but of course Africa has got all sorts of the same sorts of issues for a whole range of different countries where commodity prices have fallen dramatically. There are a large collection, as Jeremy knows, because he took me down to Canberra a couple of years ago to give a detailed presentation on Africa, of course, which I had to bone up on our views on Africa in a big way. There are about 35 countries in the 50 countries in Africa where 90% of their exports is one commodity. So you've got a very large concentration on one particular commodity for a very large collection of African economies. So on to Australia, and me being cognizant of the fact that I should probably only speak for about another 10 to 15 minutes before we go to questions. On to Australia. So these are some of the themes that I've already introduced, but I'm going to just whip through them fairly quickly. Mining investment and commodity prices have fallen. So you would think that's going to be a tougher time for Australia in order to grow, and indeed it has. It's been tougher to try and get the economy to grow in the face of mining investment and falling commodity prices. The mining investment declined, for what it's worth. We got to a peak in 2012 of about 8% of GDP. We're now at about 5% of GDP, and we're probably headed to 2 or 3% of GDP over the next 2 years. So we're about halfway through the decline. So this is certainly not over yet. Mining investment's got further to decline. Now, why is that? Well, because there was such an enormous amount of projects that got started, very big ones. I mean, the biggest part of this, 60% of all the resources sector investment that happened in that period was in the LNG sector. 8 major LNG projects being built across the country, a number of which are being built here in Queensland. They constituted about $220 billion and about 60% of all of the investment. At its peak in 2012, about 2/3 of all global investment in the LNG sector was happening in Australia. So, it was an extraordinary thing for us to try to absorb all of that. It would not be repeated, and in fact, no one ever expected that it would. You should have fully anticipated, and indeed the authorities did anticipate, certainly the RBA did, that mining investment was going to fall, because you couldn't possibly have more projects that came along that were going to be as big as the ones that came along, that were already in the pipeline. What you couldn't anticipate, perhaps, was how much commodity prices were going to fall. That's the thing that was the unknown. You didn't know whether they were going to fall a bit or whether they were going to fall a lot. As it turns out, they've fallen about halfway from their peak. They're still well above their levels of the 1990s, but they're well and truly down from their peaks. And that's a combination of two things. One, China's growth is shifting. We've already talked about that, from an investment to a more consumer-led story. And then two, and probably more fundamentally, we've brought a lot of supply on to the global market of those various commodities. And so there is a great deal of supply of commodities. So strong supply, weaker demand, prices have come down. But they haven't come down back to the levels that they were prior to the whole episode of China's emergence. They're not back at those 90s levels. They're still high relative to that. But there is an offset to this fall in mining investment, even within the mining sector, and that's the obvious one. And that is the capacity we've built is coming online. And as it turns out, even though some coal mines are unprofitable at the current level of commodity prices, the vast majority of the investments we've made in liquefied natural gas and in iron ore are bringing new capacity on stream. It's going to happen. We're going to see an LNG ramp up over the next 2 to 3 years, irrespective of the fact that the price is lower than it was. These are projects that have got 25 to 30-year contracts to sell their product to Asia. And so they will bring that on stream. The official estimates say that there'll be a 250 to 300% rise in LNG exports over the next 2 to 3 years, and we will become the largest exporter of LNG in the world. We will overtake Qatar by 2018, which is currently the largest exporter in the world. So there's an offset. So mining investment's falling, but it's being offset by a ramp up in exports, and the net of the two leaves mining GDP broadly flat, right? So we need the rest of the economy to pick up. And as it turns out, the rest of the economy is the bulk of the economy. We all know this. Mining is only 10% of GDP in Australia. It's only 2% of employment. And so 98% of employment is outside of the mining sector. The bulk of GDP is outside of the mining sector, and the bulk of it's actually in the services sectors. That's the area where growth is rebalancing towards. In its initial phase, the rebalancing act has been led by the housing market. Low interest rates supporting a pickup in house prices, housing construction, and retail sales. Okay? That's been the strongest place where we've seen the pickup. And that makes sense. Monetary policy's biggest impact is on asset prices and on the housing market in particular. House prices have risen by 30% nationally over the past 3.5 years from their trough in the middle of 2012. They'd fallen by 8% over the previous 18 months. So they've recollected those gains and now they're higher. This has been very uneven across the country, as you might imagine. As growth shifts from a mining-led story to a services and housing-led story, of course, it means that the states that are most focused on mining are doing more poorly. Western Australia is having some really tough times. Queensland, it's very variable, actually. There are parts of this state that are very focused on mining and others that are very focused on tourism and services. And so you can imagine how the split's working out. But in general, it's been a tougher time for places like Queensland. New South Wales is doing very well. Growth is picking up quite strongly. So is Victoria. Victoria is improving. In general, though, overall, business conditions are improving. Business conditions have been lifting since about 2013 because the pickup in the housing sector, the lower currency and the lower interest rates are stimulating a pickup in demand within businesses. So business conditions have been improving. Conditions have been improving so much that businesses have been prepared to take on some more employees. So employment growth has lifted from about 0.3% 18 months ago to about 2% at the moment, year on year. That's enough to get the unemployment rate to have stabilised, not enough to have pushed it down yet. And what we're still lacking is clear signs that businesses are willing to make more investment decisions. They are prepared to hire, but they don't appear to be doing as much investment as they have done in the past. So the lower Aussie dollar is supporting this rebalancing of growth. In particular, it's providing support for education exports and services exports in general, tourism. We've seen a very strong rise in Chinese tourist numbers in particular, which is actually partly the Aussie dollar, but probably more fundamentally to do with the fact that their middle class incomes are rising and they're travelling in really, really big numbers. We're talking about the numbers having gone from about 14 million. If you abstract from Chinese visits to Macau and Hong Kong, which are actually quite large, and you just look at the other visits across the rest of the world, they've gone from about 14 million in 2010 to about 32 million last year. Now Australia's seeing a large share of this as well. Our numbers have gone from about 350,000 in 2010 to about 975,000 over the past year. So we're almost at a million mark for Chinese visitors. So the currency is doing a fair bit of work for us. Our international enrolments in our education facilities have also hit new record highs in the first half of this year. So that's a positive. And I think that story's got a lot further to run. Both those stories, in fact. The share of the Chinese population that currently has a passport is only 4%. And so as their middle class incomes rise, and actually as their population ages, travel becomes more and more of a preference. And Australia is seeing some of that flow through to our economy. So jobs growth is picking up, and a part of that story, when you think about the mechanics of this, is we're shifting from growth being led by mining, which is one of the most capital-intensive industries on the planet, to being driven by the services sectors, which are highly labour-intensive, of course, so that's creating a lot more jobs. You might say it's also creating a lot more lower-paid jobs than the mining industry. This is true as well. Wages growth is much more sluggish than it was previously because the sorts of jobs that it's creating are lower wage jobs. And we are trying to make this transition as well, which is involving us having to improve our competitiveness. One of the ways that's happening is through a lower currency, but another way that's happening is through slower growth in wages, which is actually part of the reason why the employment has been lifting in the first place. Of course, there's a reform agenda that the government needs to remain focused on. We haven't had much reform in Australia in recent years. We got a free kick from rising commodity prices, from the mining boom, and we didn't really need to do very much to get the economy to grow. It was a bit of a gift from the rest of the world. We probably should have saved a bit more of it. We didn't save enough of it, so now we're left with commodity prices having fallen. We need to shift tack to something else, and in order to make that happen, we need to be more competitive. Now, the currency is helping us a lot. I mean, that currency coming down from 105 down to 70 cents makes a very big difference to our competitiveness. But there are all sorts of other areas where we need to be focused on productivity. So I'm going to show you a few charts on some of those themes, but I'm conscious that I'm also at 1 o'clock already. So I'm going to show you some of the themes, and then we're going to see if there's some questions. This is one I like. It's probably the most impressive one that I carry around in terms of just the story, and that is Australia is in its 25th year of continuous GDP growth. This is an unprecedented period of expansion in Australia's own history. There is no other expansion of that length. There is no other country that's managed to expand over that particular period of time for 25 years. We managed to avoid the Asian financial crisis. We managed a contraction during the Asian financial crisis. We managed to avoid a contraction during the IT bubble burst. We managed to avoid a contraction when the global financial crisis arrived. The comparable country that's managed in the developed world statistics is the Netherlands, which managed to expand up until the global financial crisis for a 26-year period. But if we get past that 26-year mark, which I suspect, well, my forecast says we will, but we'll see. We'll see when we get there. If we get past that 26-year period, we will have had the single longest period of expansion of any developed world economy in the statistics, which is, starting to sound reasonably impressive. The other thing that's quite interesting about this chart, for those who are eyeball econometricians and like to look at charts in a lot of detail, is, of course, that the volatility of GDP has reduced substantially since the 60s, 70s, and 80s. So we must be doing something right. And I think, fundamentally, we've made our economy more flexible by a lot of the reforms we put in place in the 80s. But probably the one single factor that you can point to that's the most pertinent, the one that really has reduced the volatility, is the floating currency. Is that instead of GDP going around like this, the currency goes around like this, and so it's acted as a shock absorber. When commodity prices went up a lot, the Aussie dollar went up a lot. When commodity prices went down a lot, the Aussie dollar went down a lot. It's been acting to take a lot of those shocks and try to, the appropriate relative price signals have been sent for the appropriate type of activity to occur. So, if you want to come back to your sort of market fundamentals, then that really tells you that the currency is doing what it ought to do, which is an unusual thing across the world. There's a lot of skepticism at the moment about the idea that currencies can actually help countries, that the currency movement just hasn't delivered. It's fallen, but we haven't gotten any more growth. We haven't gotten that demand kick. And for Australia, at least, for the moment, you can say, well, the currency's really been doing what it's supposed to be doing. It's been tracking commodity prices in broad terms and therefore offsetting the negative and the positive shocks for Australia to a large degree. So here's a couple of pictures I've already referred to, but obviously we went through an enormous ramp up in our terms of trade as a consequence of the rise in commodity prices, and now we're at the back end of that. It's falling. Whether it stabilises, this is a forecast, and this is one of the hardest things to forecast there is. You're trying to forecast other countries' demand for commodities and obviously the global supply of commodities and where those two meet to get to a price. So a nice little neat working assumption is not to do very much actually, and just say, hey, it might stay roughly where it is, because you don't really know whether it's going to go up or down. And as a working assumption, that's not an unreasonable one. But we are dealing with a fall in the terms of trade, of course. We're also dealing with a very large fall in mining investment after the big ramp up. It may very well fall a bit more than this. These are our current set of forecasts. I know the RBA is a bit more bearish on this story, so it may be that it falls a bit more. This is my favourite, or one of my favourites within the pack. This is breaking up GDP into two parts, breaking it up into mining GDP and non-mining GDP. Now keep in mind that the black line is 10% of the economy. So mining GDP is only 10% of GDP, and 90% of the economy is outside of mining, so that's the red line. Well, you can see what happened. Mining GDP, because of the mining investment boom, ramped up substantially. It was running at 20% in 2011-2012. Now keep in mind, if 10% of the economy is growing at 20%, it's contributing 2 percentage points to GDP growth, right? In that year, we had GDP growth of 3.5. So it was contributing over half of all GDP growth, even though it's a small sector of the economy, just 10%. And so it slowed down, of course, and now it's not growing at all. It's stopped. Why is it stopped? Because exports are ramping up, investment's falling, and the net of the two is pretty much a flatlining mining sector in terms of a concept of GDP. So we need growth to shift to the red line. We need it to pick up in the non-mining sectors. Is that happening? Well, firstly, it should be able to, because this is sort of the broad story. Mining is that black bar on the left is a share of GDP, and the red bars are all the other sectors. The services sectors make up the bulk of Australia's economy. Are we seeing it happen? Well, the first sign of the impact of low interest rates has been in the housing market. House prices are up 30% since their trough in the middle of 2012. They fell by 8% over the previous 18 months. So part of it was just recollecting losses from previously. But now it's gone a bit further than that. Why has it gone a bit further than that? Well, because as growth has been shifting towards the New South Wales and Victoria, actually the Sydney market has gone up very rapidly. Now this is not just a story about Sydney. You can link this back to a global story. Every global city around the world is seeing rapid growth in house prices. Why? Because global interest rates have been very low for a long time. In fact, close to zero for a long time. And what that does is it pushes up asset prices. Firstly, it pushes down bond prices, which of course makes sense because interest rates at low levels, when yields are the opposite of prices, so bond prices go down. So they get to a level where people start saying, well, are they going to go any higher? No, I need to move to the next asset class. So they move to equities. The equity prices have gone up a lot. They're already at quite high levels, particularly in the US on PEs. So now they don't really want to buy too many more equities because that's a bit of a worry. They're already quite high. So what do next? They buy property. And where do you buy property? In the major cities, because that's where it's easiest, most accessible, most likely to stay resilient. So commercial property prices have been rising around the world, and so have house prices. And so it's not just a domestic phenomenon, it's a global phenomenon as well. Low interest rates locally, of course, have supported this story as well. So Sydney and Melbourne house prices have been rising quite quickly. As you can imagine, the other states haven't fared quite as well because they're much more exposed to the resources sector. But this is, in broad terms, what you would have expected to happen. And in fact, it's not a terrible story. The RBA wanted house prices to rise because they needed growth to rebalance. Now, that pickup in house prices was needed also to get the construction boom to pick up. This is residential building approvals. They're at their highest level in history. This is a good story. We weren't building very many houses when we were building lots of mines back in 2011, 2012 because we were holding it back. Now what we're doing is building houses rather than building mines, and that's a good story. There's been a shift in terms of the resources are moving, or capital and labour are moving from the mining sector towards the construction story for housing. And so that's a good story. It's flowing through to a pickup in retail sales. As you might expect, people are building more houses, their house prices are going up, so they're buying more furniture and more stuff to put in their houses. And that's clear in the numbers as well. And fundamentally, the main thing that's happened just recently that's a bit more positive as well is you've seen that business conditions have been improving. When you ask businesses, this is a survey, that the black line is a NAB survey, they ask 300 businesses a month how they feel about the world, and they've been saying things have been improving, certainly since where they were in 2013, gradual improvement in business conditions. And that's saying that this story of a rebalancing of growth is not just now in the housing market, it's broadening a bit more. It's services firms where things are really picking up. And that's where you're seeing the employment growth. This is employment growth in the red line, aggregate hours worked. They're both running at about 2% year on year, which is a pickup. It's not enough yet to get the unemployment rate to fall, which is what I've got here. The unemployment rate's been steady, but it is enough to get the unemployment rate to stabilise. So there are clear signs that growth is rebalancing. It's shifting from a mining-led story to the non-mining-led story. What's the next driver of growth going to be? Well, in our view, it's going to be led by demand from the Asian economies for a lot more of our services. We're seeing this in particular in terms of the tourism industry. These are short-term arrivals. I've already talked about this, but China has gone from 350,000 to 975,000 over the past 5 years in terms of tourist arrivals into Australia. International enrolments in our education facilities have picked up. They're at record highs in the first half of this year as well. These are the areas where we're going to see more growth. Is it enough to offset the slowdown in the resources sector? Well, that's the big open question. So far, so good. We have actually seen that there is enough momentum in the economy to keep the unemployment rate stable, and we think that that is going to continue to be the case. And the RBA obviously has become a bit more confident about this story as well, having left interest rates steady. The question, of course, for the RBA is, do they need to get a little bit more stimulus in there to get this growth to continue, or is this going to be enough? Is it going to be self-perpetuating? And the challenge they have is at the same time that this is all happening, from a global perspective, inflation is very low everywhere. Inflation's low everywhere. I've showed you the US. European inflation's low as well. It's low. Disinflationary pressures are everywhere. And Australia's inflation is now starting to look quite low as well. This is the underlying measure of inflation, or the two underlying measures they focus on. It's at the lower half of their target band. In the last 6 months, it's below their target band. And their concern may be, although growth is lifting and the rebalancing is underway, of course the question is, do they, inflate? Will it be enough to keep them on target for inflation, or do they need to deliver a bit more stimulus? Now, I've covered an enormous amount of material in a fairly short period of time, and I know I've also haven't covered everything. There are some more slides in here, but I want to make sure I stop in time, that there's plenty of time for questions. So, how much time have I got? About 10 minutes?
Yeah, we told folks that we would have them out here by 1:30.
We'll stick by that. That's a good plan. And
Fantastic.
is it all right if I take 10 minutes of questions, and then Mike, you're going to get
I
up?
think it's great.
Cool. Okay.
Okay. Paul, what do you think the impact of the China Free Trade Agreement will be on the expansion of export for Australian services?
It's a really good question, and I think in general that having a free trade agreement with your largest trading partner is a positive. It's a positive. We have a free trade agreement also now with Japan and Korea as of last year as well. I mean, the most vivid things in the free trade agreement are there will be a reduction in tariffs on our agricultural exports. That's very clear. That should be somewhat supportive of the agricultural story. I haven't talked about that very much, but it's a very important one. As Chinese middle class incomes rise, their diets will shift, and they'll be consuming more meat, more dairy, more sugar, more edible oils, what we've been calling the finer foods. And so us being able to try and be more competitive in that market is a really important step, and the free trade agreement should help in that regard. But probably the most interesting part of the free trade agreement is the services areas. So the free trade agreement gives us preferential access to provision of aged and healthcare services and tourism services on the ground in China. Now the question is, so we are able, wholly owned Australian operations can operate in China aged care and health facilities. The question is whether we do find businesses, although the pathway is set, by the government in terms of allowing that to happen, whether there are businesses that are prepared to take the risk in order to do that, because that's an area where another area beyond education and tourism where we could see more involvement from Australia. Our health services industries and our medical technology industry could get more involved in the China story, particularly as their population ages. You know, the numbers are quite phenomenal. Over the next 30 years, they're expected to be 240 million new people in China that are over 65. It's a big number of people. And so, you know, getting involved in that might be quite helpful. But I mean, as you know too, it's hard to predict exactly what will happen as a consequence of the Chinese Free Trade Agreement. There's probably one certainty, and that is the other thing the Chinese Free Trade Agreement does is lift the thresholds on Chinese inbound investment into Australia that don't require FIRB approval. So the current threshold is 288 million. It goes up to 1.74 billion or something along those lines, a little over $1 billion. It's almost guaranteed that there will be more capital flowing towards Australia from China as a consequence of the Chinese Free Trade Agreement, just because those thresholds have been lifted. But in general, a positive thing. Is it a really big positive thing? I think time will tell, and it's very hard to forecast that. And the government's estimates actually suggest it's going to be quite small. I don't know whether you've seen the paper they published, but they got a consultant to publish something, and it basically shows that it's not actually going to contribute that much to GDP growth over time. But you never know, it might contribute more, and it's certainly moving in the right direction.
Thanks, Paul. Just referring to the statement on monetary policy last week, the Reserve Bank basically, I think they dismissed that projection in the forward estimates of capital expenditure, the anticipated investment. I think you've got a slide on that in your pack.
I do.
I'm just wondering what your thoughts on it are. I mean, they noted that, well, this isn't a complete coverage of non-mining business investment, but still, I mean, it is, in my view, it is a concerning bit of data. I'm just interested in your view.
Sure. I think this is a really important point. I've written a bit about this, actually, and it was good to see the RBA writing about it as well. This is, so let's frame it slightly differently. This is the CapEx survey. We have a survey in Australia, the ABS publishes it, of the outlook for investment. They ask a whole bunch of firms what they're going to do in terms of what their investment plans are. As it turns out, firms don't really know what they're going to do. It's a terrible survey in the sense that you have to make a lot of adjustments to even get something that's even close to sensible in terms of the outlook for investment. This is what the last survey showed. Mining investment's going to fall quite sharply. No surprises. Everyone knows this. This is expected, and in fact, we all know mining investment is coming off. But the surprising part is that dot is for the black dot, the non-mining investment, because the CapEx survey says that even though non-mining companies had lifted their investment last year, this coming year it's going to fall. And even though business conditions are improving and businesses are prepared to take on more employees. So it seems a little odd. It's kind of inconsistent with what you'd imagine, until you dig a little bit further. And what you find is that dashed line is the CapEx survey. The black line at the top is total non-mining business investment. That is to say, the CapEx survey only covers half of all non-mining business investment. So it's this particular survey that we're talking about where it only covers half. And the bit that's missing is all the services sectors. Services sectors are a heavy weight in what's missing from this survey. The dashed line has the manufacturing industry in particular, and things are quite weak. And then it has a small collection of services industries. So it's possible, and they're alluding to the fact that maybe it turns out that the services industries, which is where we're seeing the growth at the moment, where we're seeing the employment, are going to do a bit more investment. It's just that they're not well captured in this dashed line in the CapEx survey. The other possibility is the services industries just won't do much investment, because it turns out that services tend to be pretty labour intensive and not very capital intensive. So actually you should expect business investment is going to be a bit weaker in the future, because we're shifting from mining to the non-mining sectors. And those are all the things they were talking about.
Interestingly, that's what Chris Kent said when he was here a few months ago. So.
This is just a quick question about the education sector.
Yes.
Since the education sector is a very important sector in Australia, I guess this is a bit of crystal ball gazing. In various countries, as the middle class increases, so there will be, so they will develop their own institutions, their own areas of education. So therefore, will there in Australia be as much activity in the education sector as what there is now with the growth of middle classes in other countries?
So I think, I mean, the issue for us is manifold. There's a few issues. The first issue is obviously the major role of the education industry in Australia is to provide education to Australians, to try to build up our human capital, and that makes us more, and that's a highly important thing for us to do, because if we are truly moving towards being more driven by the services sectors, those services sectors require educated people, people who've got higher knowledge. And so if you look at other countries, the issue, of course, is how much can we benefit from exporting services, education services to them. At the moment, my understanding is we rank just behind the US. Perhaps we're behind the UK as well, I'm not sure, but certainly up in those top three in terms of education destinations for international students. Education exports for Australia is our third largest export, behind iron ore and behind coal. And so we're already quite large players in this space, right? We're already quite a large player in the international education space. We need to do more, though, I think, to try and make sure we are as attractive as possible. And focusing on that industry is important. Now, I'm not sure I've completely answered your question.
I think I meant mainly in terms of overseas students. As the middle class increases in many countries, so the education standards will rise, and so they will develop their own institutions, which may mean that prospective students may not need to come to Australia.
That's absolutely right, and I think that is happening too. The question is, to some degree, whether, when we're talking about a country of 1.34 billion people like China, you don't need very much of a share of that market to have a very big impact on our very small country down here. So all you need to do is have a slight preference change on the part, or this continued preference for doing some study offshore, because you get a diversity of experience. Perhaps you come to Australia because it gives you better language skills that are useful for global business. Perhaps you come here because you want an attachment, you want a different experience in terms of living in a different country. It doesn't take very much of a shift in preferences from international students, in particular China, to have a big impact on our relatively small sector. And I guess that's the point. You're absolutely right. Their education industry is expanding too, and greater provision of domestic education services is no doubt picking up, and it's improving. But it's really about whether we can get some more of that market that's out there. One thing we can say is, in the past, we've actually done a fair bit of this. I mean, these numbers have grown a lot in the past. They slowed right down when the Aussie dollar was very high, but we have been doing this in the past. So there is more, I think, opportunities for this to lift in the future. But sure, we will be competing with other countries on development of their own education facilities. The other option for us, of course, is to take some of the skills that we've got onshore and take them offshore, which I think a number of the universities are already doing.
Right. We probably have time for maybe one more before a vote of thanks.
Sure.
Or is there...
Thanks, Paul. It's a great talk. I was just, I guess, talking about the education system, sticking there. It seems like that appears to be the bigger service that we could provide. However, I guess philosophically, is it the role of the Australian government to take taxpayers' money to risk it on investments to try and bring people here that may or may not pay us for a good return on those facilities to provide education? I don't know if that's is there a better way? Have you seen or heard better ways that Australia can tap into this services sector in, say, China with the rising middle class, etc.?
My understanding is that when international students come here, they're full fee paying, and actually they're a very strong source of revenue for the education facilities. So it's not that the government's actually subsidising the international students. Actually, they provide more funding, or it's a profitable industry. It's an industry in and of itself. Sure. Well, I think the government would need to consider, in terms of a policy perspective, that we're doing both. We need to be able to provide both domestic provision of education services that improve our human capital and therefore give a return over the medium term. But there's no reason to think that we couldn't also, at the same time, also have an industry that benefits from, income that comes from the rest of the world for full fee paying students. To some degree, I actually think, I mean, if you look at the US and the UK model, I mean, these are, they've got highly esteemed, globally competitive education facilities, and a big part of what allows them to do that is that they draw the best from across the world, of the best minds from across the world, and they all collect together, and you get your agglomeration benefits. I don't think we're quite there yet. I don't think we could say that we were there yet. I think most of what we're doing is not in that space. But I think that's something we ought to aspire towards, and being able to do. I mean, Australia is seemingly a preferred destination for people from Asia to come to study. I talk a lot about China, and it's an important market. It's probably it is the major one. But I travel through Asia quite regularly, and countries like Malaysia. I mean, there's an enormous attachment between Australia and Malaysia that until you go to Malaysia and talk to people and they meet you and you're an Australian, you don't realise that actually there's an enormous amount of Malaysians who've studied in Australia, who got educated in Australia, and they've gone back to work in Asia. And so all of the I think there are a collection of Asian economies that are really opportunities for us to be able to provide these knowledge services. And that's what we ought to be aspiring to, unless you think I mean, the challenge is, what is the next thing if it's not going to be these things? The resources story, the boom is over. It's not likely to come back anytime soon. I think the resources story, there's such an enormous amount of supply in the global market of resources, and China's demand is slowing for these things. India at some point in time will take off and need these sorts of things, but they've got a lot more of it themselves for a start. They've already got an endowment, and they're also a long way off in terms of being a very big source of global demand. So we need to be shifting. Now, the thing is, part of this is policy. Part of it is policymakers getting the right settings for this. But a very large part of it is relative price settings, right? That's how Australia's economy tends to adjust. The currency goes down, and that provides support for industries that get support from a lower currency. And so a lot of it happens more organically than that. It happens because of the relative price settings. I'll leave it there.
Fantastic. Michael.
Yeah, sure.
Thanks.
Yep.
Do I stand here?
Wherever you like.
Where's that? Where's the...
Oh, it's in
I'm sorry. Right. Yeah. Excellent. Yeah. My name is Michael Knox, and I'm the immediate post-president of the Economic Society of Australia Queensland Division. It's notable that people who have a connection with the RBA, both current or past, really go out of their way to help the Economic Society. Paul says that he was previously a state secretary in New South Wales. I've spoken to other people about, or heard from other people, how that burden does fall upon some of the members of the RBA. But I've also seen Paul, since he left the RBA, tirelessly go out of his way to help the New South Wales branch by presenting at their events and some of their conferences, as he's been enormously good to us in presenting for us today. I kind of remember when Paul's predecessor was in the job at HSBC and coming towards the end of his time, and the word was around in the market that they'd started to interview for a successor, and when the question was asked, well, who are they interviewing, and they say, well, they say he's the smartest guy in the RBA. Now, Paul had deferred from this, but I think after today's presentation, they might have got it. Now, Paul, we in the Economic Society of Australia Queensland Division have a great respect for the history of the society. And we honour traditions, not just traditions of the history of the society, but also the history of Australia. And we cast our mind back in one of those practices to a group of far-sighted central bankers earlier in Australian history who founded the first highly liquid Australian currency, which could be exchanged both for goods and services in Australia. Tragically, this was suppressed by the British government of the day as the Rum Rebellion. But we've always attempted to honour this by payment in alcohol. So please accept this, this bottle of fine Australian wine.
Thank you.